In this video, we will take an in-depth look at one of the key tools of the smart money concept, the breaker block, covering all the nuances. Despite the huge popularity of the concept, there is objectively not enough information on this topic available to the public. Everything is superficial and doesn't even answer the basic questions. The key difference between a breaker and an order block, mitigation block, or imbalance is that a breaker forms at the moment of a trend reversal and is exclusively a reversal formation that changes the market's direction. We can trade it at the initial stage of a trend change from bullish to bearish and vice versa. The formation of a bullish breaker begins when the price reaches a significant institutional support zone from a higher time frame. The formation must include three structural elements: lower low, lower high, and another lower low. These are 5 candle swings. At the lower high extreme, a bearish order block must be formed, and an impulsive breakout of this block will turn it into a bullish breaker block. It is expected that the price will return to test it, react, and then continue to rise. The breaker range is our support zone from which it makes sense to consider long positions. Now let's go step by step. Why does this work and what is behind it? Essentially, this is a classic bear trap that perfectly illustrates how smart money operates. The main event is the taking out of the lower low. At this point, smart money pursues 2 key objectives: to fill their buy orders and to create a liquidity pool on the other side for a future markup of the asset. To achieve these goals, they artificially create a breakout, which provokes uninformed traders to sell, while at the same time triggering stop losses that were previously set just below the local low. A huge number of sell orders enter the market, allowing smart money to fill the necessary volume of their buy orders. As a result, a logical revaluation of the asset occurs in an upward direction, with the structural lower high being updated, which, for adherents of traditional technical analysis, automatically becomes a significant support level. Traders who opened short positions on the breakout are now at a loss, and they will seek to minimize their risks during the retest of the previous high. And the closing of short positions means buy orders, which will act as a catalyst for further growth. In fact, smart money uses this to provide free upward momentum for the asset they want, profiting from it. But if you want to see how everything I'm talking about is used in real time, subscribe to my Telegram channel via the link in the description. There is also a public chat where you can communicate with other traders. Now, a few basic nuances that determine how correctly and effectively you can use this tool. First, you need to make sure that the price has consolidated above the broken lower high, because this confirms the smart money's intention for a future revaluation of the asset. And we, as smart money traders, will aim to follow them when opening our positions. If there is just a sweep and the candle body closes below the high, then the formation of a breaker is ruled out and we can no longer look for positions based on it. In our case, the candle body consolidated beyond the swing, so we determine the upper point of the breaker range by the extreme of the broken swing. This is the point where uninformed traders will try to close their losing short positions to minimize risks. The lower point is the minimum of the bearish order block. We determine it only in order to place an aggressive stop loss beyond it. If we want to trade more conservatively, then we will place the stop loss beyond the last swing low from which the upward movement began. In that case, the lower boundary of the breaker will not have any practical significance to be defined. In many cases, a single line will be enough for you to trade the breaker. This is a rationalization of analysis that you will come to over time. For now, take a look at the highlighted ranges and choose the correct options. We already know that the first option is correct. The second option differs in that the swing's extremum was formed by a falling candle and does not stand out, which is a mistake because it ignores the logic of how the breaker works. But the third option takes this into account, and based on the marked range, we can trade. And the fourth option ignores the candle wicks. It does not comply with the basic principles of how the tool works, both in terms of starting to look for a position and setting a stop loss, which makes it ineffective and useless in practice. To trade the breaker effectively, you need to understand how to enter a trade from it and where to place your stop loss. The most basic and simple way is to place a limit order to go long at its beginning. At the same time, the stop loss can be either aggressive or conservative depending on the situation. For example, I only use an aggressive stop loss if the minimum of the range coincides with the minimum of the impulse candle that broke through the structural lower high. Otherwise, I will always choose a conservative stop loss. This is due to the newly formed bullish inefficiency, which serves as a marker of active smart money buying and their intention to push the price even higher while protecting the current range. Thus, the lower boundary of the breaker is validated for placing a stop loss beyond it by the bullish imbalance, which may be balanced on the very next candle, after which the growth will continue and a return to the breaker is not expected. This will be the second, more precise entry from the breaker. The fulfillment level of an as-yet unconfirmed imbalance is used to open a long position, allowing you to achieve the best risk-to-reward ratio within a bullish setup, even with a conservative stop loss. But this does not always happen, and sometimes the inefficiency is not filled completely, leaving a gap that the price will naturally tend to gravitate toward. Therefore, the entry into the trade will be made from its beginning. For me, this is the most optimal method of entering a trade. The breaker is a reference point, a key support zone, while the imbalance within it is a secondary zone that is used for a better entry, both in terms of risk-reward and timing. The next entry is a modification of the previous one and involves using the volume profile for the range of inefficiency that has arisen within the breaker. The level where the lowest volume has been traded is highly likely to become a trigger for the price. This is where we can place a limit order to go long. These are the 4 key trade entries when trading the breaker. They are simple, reliable, and effective. In reality, analysis is not limited to just one time frame. We will use at least 2. For example, in our case, the weekly time frame is used as the guiding one. On it, we identify the support zone from which a reversal occurs, and the resistance zone, which acts as a magnet for the price and, accordingly, as the target for the future revaluation of the asset. We are waiting for growth from one zone to another. But to open a trade, it is necessary to see confirmation of a reversal in the form of a bullish breaker on the daily time frame. With the removal of the first structural lower low, there was a test of the 1-week POI, followed by aggressive growth during which the lower high was broken. The closing of the candle body above it confirms the breaker. Therefore, already at this stage, following the plan from the weekly time frame, long positions can be considered. Now we have the option to set a limit order either at the start of the breaker or at the level of the fulfillment of the newly formed inefficiency. I choose the second entry as it offers a better risk-reward ratio and more flexibility. The logic is simple. If it is not triggered on the next candle, a 3-candle imbalance formation will be created. In that case, we simply move the limit order to its beginning, or for greater accuracy, use the volume profile to enter at the level with the lowest reading. A stop loss behind the breaker will be acceptable because the low of the breaking candle is located at its lower boundary. But given the rather ambitious targets, it is more rational to set a conservative stop loss behind the last low, thereby improving the probability of our trade working out successfully. Setting a single take profit is not the best trade management strategy because your scenario may only play out partially, for example, by 90%, after which a reversal may occur. In that case, you won't earn anything, you'll only lock in the initially planned loss. Depending on the situation, I split profit taking into 3 or 4 take profits, identifying intermediate problematic zones and liquidity pools. The volume of profit taking can be distributed in different ways, and this depends on the risk-reward ratio of the trade and the context in which you are trading. In our case, I would take profits according to the scheme of 30, 20, and 50, or 25, 25, and 50. It's not crucial. When the first take profit is triggered, the trade becomes risk-free even without moving the stop loss. If we move it to break-even, then profit is already guaranteed. The final risk-reward ratio, of course, will be slightly lower than the initial one, and that's a reasonable price for increased control over your trades. Now, the bearish breaker, it is completely analogous to the bullish one and works in a mirrored fashion. It develops from the formation of structural higher highs, higher lows, and another higher high. The rise reaches a logical reversal point in the form of a significant resistance zone from which the asset begins to be evaluated, resulting in the break of the higher low. The closing of the candle body below the swing is a key aspect that validates the bearish breaker. From this moment, it becomes a full-fledged resistance zone from which we can consider short positions. It is expected that the price will attempt to test the breaker and subsequently receive a strong reaction, after which the decline will continue. This is due to a huge influx of sell orders entering the market. Poorly informed traders who previously opened long positions will try to cut their losses by closing them. Opposite positions will inevitably be formed as well. At this stage, an entry can be considered from the beginning of the bearish breaker and at the fulfillment level. If the imbalance is confirmed, then the entry will take place from its beginning. And the fourth option involves overlaying the volume profile on the bearish inefficiency. The area with the least trading activity will be used to place a limit order. An aggressive stop loss is relevant only if the high of the breakout candle coincides with the upper boundary of the breaker. In all other situations, only a conservative stop behind the last swing high is considered. In this example, on the hourly time frame, we see a resistance zone in the form of an order book. This is a range from which a reversal may occur, and below it, there is a distinct imbalance acting as a magnet for the price and the primary target for a potential drop. Switching to the 15-minute time frame allows us to identify a bearish breaker. A limit order to short is placed at the fulfillment level. The stop loss is conservatively placed above the last high, and the take profit is set at the beginning of the bullish imbalance on the hourly time frame. We will also add two intermediate targets at local problematic levels, from which a reaction may follow. The limit order was filled, and since there was no inefficiency left in the breaker range, the decline continued immediately. So, in order to trade a bearish breaker, you need to identify the resistance zone from which a reversal will form, and then determine the target for the upcoming decline. This is done on higher time frames. The lower time frame is used to identify the reversal formation, which often resembles the letter M and consists of structural higher highs, higher lows, and another higher high. An impulsively falling candle that breaks through the higher low must close below it, leaving behind bearish inefficiency. This simple combination of factors will allow you to place a limit order to open a high quality and highly effective short position. With a bullish breaker, everything is the same, just the other way around. Everything is on the screen, so I won't repeat myself. When this video gets 2,000 likes, I will analyze the mitigation block in just as much detail. Good luck.